Let's get straight to the numbers that every American who cares about the dollar's influence worldwide needs to see. In March 2026, China's CIP payment network, the direct rival to SWIFT, handled transactions totaling $214 billion in just that month, as both Russia and Iran accelerated their departure from dollar-centric markets. On its single busiest day, CIPS moved 1,220 billion yuan across 42,000 individual transfers, figures that set all-time records. Daily activity surged dramatically, with the average value of transactions in March reaching 920.45 billion yuan, a 50% increase over February. Looking at bilateral trade, China and Russia exchanged 245 billion in 2024, exactly double the volume from 2020, with more than 90% settled in yuan and rubles. Russia has completely removed the dollar and euro from its $600 billion international reserves, holding instead monetary gold and yuan. Meanwhile, Saudi Arabia, long America's pivotal energy partner whose 1974 agreement helped establish the petrodollar that underpinned 5 decades of U.S. financial supremacy, recorded 41% of its oil sales in yuan during March 2026. Adding to the shift, 2 major Saudi state-owned banks formally joined the CIS network. Analysts in Greater China and North Asia describe these developments as potentially catalyzed by Middle East tensions, signaling what may be the early emergence of a petro-yuan era. Despite these trends, the dollar remains dominant in 51% of global SWIFT settlements, while UAN accounts for only 3%. Yet, the infrastructure supporting alternative networks hit record transaction volumes in March, continues to grow at 50% per month, a pace that cannot be ignored. CIPS, China's cross-border interbank payment system launched in 2015, was designed to support UAN-denominated international settlements and the global expansion of Chinese currency. Initially, its role was modest, facilitating Belt and Road projects and limited yuan trade flows. By the end of 2025, CIPS had connected over 700 financial institutions across 189 countries, cumulatively processing $94 trillion in annual transfers and sustaining growth rates exceeding 43% for multiple consecutive years. However, nuance is crucial to understanding this story. Over 80% of CIPS transactions still depend on SWIFT's messaging network, highlighting that these systems are currently more complementary than directly competitive. SWIFT continues to link more than 11,500 institutions in 235 countries. UAN occupies only 3% of global SWIFT currency flows, compared to 48% for the dollar. The dollar's supremacy is structural, anchored in decades of infrastructure, legal frameworks, and entrenched institutional habits that cannot be dismantled quickly. Acknowledging this reality is vital for a sober assessment. What changed in February 2026, however, makes the March surge more than just a spike in volume. China implemented its first major update to CIPS rules in 8 years, extending its capabilities beyond UAN-only transfers and opening the door to multiple currencies and additional payment channels. CIPS is no longer merely a UAN settlement system. It is evolving into a global payments platform capable of handling various currencies, competing with SWIFT across broader domains, and enabling participants to bypass the dollar if they choose. Experts at the Shenzhen Advanced Institute of Finance have confirmed this strategic shift. CIPS transactions are expected to expand from traditional trade settlements into financial market operations, liquidity management, and integrated cash management throughout 2026. The system is being upgraded from a bypass lane into a fully parallel highway. The core strength of the dollar does not lie primarily in its role as a store of value, but as the indispensable intermediary for global commerce. Nearly all international payments still pass through correspondent banks with U.S. connections, granting Washington the authority to monitor, restrict, or terminate financial relationships anywhere on the planet by applying OFAC sanctions. March 2026 was more than a record month. It may represent an inflection point in the global payment architecture, revealing both the resilience of the dollar and the accelerating capacity of alternative networks. Understanding these shifts is essential for grasping the implications for personal purchasing power, borrowing costs, and the long-term stability of savings worldwide. The United States' ability to sever any nation from global trade with a single Treasury Department action represents the most formidable financial weapon ever forged in peacetime. Its potency comes from the dollar's central role in nearly every international transfer. But once the dollar is sidelined, the weapon's reach diminishes. Every WAN payment processed through CIS instead of SWIFT bypasses U.S. oversight, leaving the Treasury unable to monitor, limit, or impose sanctions directly. This is not hypothetical. The system's architects explicitly designed it for that purpose. One institutional analysis summarized it plainly. CIPS does not overthrow the dollar's reserve currency status, but it erodes a critical pillar of dollar dominance, the authority of financial sanctions. That distinction matters deeply, Dollarization is not a single process. It runs along two parallel tracks. One is gradual. Reserve currency status shifts slowly, reflected in IMF COFR data, by 1 to 2 percentage points per year. The other moves rapidly. Sanctions evasion networks expand, measured by CIPS transaction volumes growing 50% monthly whenever geopolitical events spike demand for dollar-free channels. March 2026 was a lightning-fast acceleration. The Iran war, the IRGC demanding yuan or cryptocurrency fees for Strait of Hormuz passage, Russian oil settlements, and Saudi banks joining CIPS all collided at once. The outcome? Record-breaking daily and monthly transaction volumes, and a formal CIPS policy revision authorizing global multi-currency settlement. In the same period, Russia entirely removed the dollar from its reserves. Globally sanctioned entities deployed $154 billion in cryptocurrency during 2025, a nearly 700% annual surge, creating an additional bypass around the yuan system. The chief economist at Deci Life Research Institute stated plainly, the shift away from the dollar will accelerate as these alternative networks reach critical mass. The weapon is intact, but the armor it was meant to pierce grew significantly thicker in March 2026. That month, CIPS processed $214 billion, a 50% increase from February, setting all-time single-day and monthly records. Saudi Arabia conducted 41% of its UAN oil transactions through the same month. Russia fully eliminated the dollar and euro from its reserves. Sanctioned entities used $154 billion in cryptocurrency in 2025. The dollar's reserve share fell below 57%, marking a 30-year low. Analysts from a major global financial institution declared the trend irreversible. Yet the full picture is more nuanced. While the dollar's role is under pressure, it remains remarkably resilient, and the degradation of sanctions capabilities is the most strategically significant story, even if a collapse of reserve currency dominance remains decades away. Every serious American investor should internalize the balanced reality. The dollar still accounts for 88% of all global foreign exchange transactions. It represents 51% of SWIFT payment currency usage compared to UAN's 3%. Surveys of global central bankers, published by the Carnegie Endowment, indicate that net demand for dollar assets will likely exceed combined demand for euro, renminbi, yen, and pound assets through 2026. SWIFT maintains connections to 11,500 institutions across 235 countries. CIS links 1,700 institutions in 189 countries and continues to rely on SWIFT's messaging for more than 80% of its transfers, meaning the networks are complementary rather than directly adversarial. Most CIPS participants are institutions embedded in financial groups deeply tied to the dollar system, vulnerable to U.S. secondary sanctions if they openly defy Washington. Analysis by the Heritage Foundation emphasizes that CIPS is not a comprehensive substitute for the majority of global commerce. The yuan is not fully convertible, and China continues to manage its exchange rate. These structural realities limit how rapidly the yuan could replace the dollar as a true global reserve currency. Historically, voluntary moves away from the dollar unfold over 15 to 20-year timelines. The British pound's decline from 65% of global reserves in 1913 to negligible levels spanned 40 to 50 years. No one is replacing the dollar overnight. The essential insight remains: the erosion of the sanctions weapon is the most consequential shift in global finance today, directly affecting every American's money, regardless of whether full dollar displacement occurs in 5 years or 50. Dollarization is multifaceted and ongoing, not a single linear process. Dollarization unfolds along two distinct speeds. The slow track, reflected in reserve currency status, shows a gradual decline from 72% in 2001 to 56.9% in 2025, according to IMF data. This trajectory is real, but it moves slowly. The United States' deep capital markets, rule of law, credibility, and entrenched institutional framework mean this evolution spans decades. The fast track, however, is sanctions enforcement infrastructure. Its velocity is measured by CIPS transaction volumes, the growth of alternative payment networks, and the architecture of bypass mechanisms built since 2022. These systems surge 50% per month when geopolitical events trigger demand for dollar-free channels. The critical factor is this: the power of U.S. sanctions does not depend on whether the yuan makes up 3% or 30% of global reserves. It hinges entirely on whether transactions must pass through U.S. correspondent banks. Every transfer routed through CIPS bypasses American banks entirely. The Treasury cannot monitor it, cannot restrict it, cannot enforce sanctions. With each additional dollar flowing through CIS, the reach of the sanctions weapon contracts, independent of any reserve currency shifts. CIPS annual processing reached $25 trillion in 2025, a 65% year-on-year increase from 2022. Following the February rule revision, the platform expanded into multi-currency operations, enabling settlement of financial markets, liquidity management, and integrated cash management through 2026. Within BRICS nations, 67% of intra-block trade is now conducted in local currencies, up from under 20% a decade ago. The new development bank aims for 30% of financing to be in local currencies by 2026. Projects like BRICS Bridge, a wholesale CBDC settlement system, and BRICS Clear, a proposed securities clearing infrastructure, are actively developing, establishing a complete alternative financial stack from payments to security settlements. This is not abstract geopolitics. It directly affects American households. The dollar's reserve currency privilege saves the U.S. government an estimated $100 billion annually by suppressing Treasury borrowing costs. That structural demand comes from global accumulation of reserves. As BRICS nations, Middle Eastern sovereign funds, and emerging market central banks marginally diversify away from dollars each quarter, U.S. Treasury yields remain structurally higher. The 10-year Treasury currently sits at 4.41%, despite multiple Federal Reserve rate cuts. IMF data from 2026 confirmed that the safety premium on U.S. Treasuries is narrowing measurably, which is already reflected in 30-year mortgage rates, ranging from 6.3 to 6.83%. Sanctions erosion adds another transmission channel. When U.S. sanctions credibility diminishes, when CIPS routes bypass enforcement, when cryptocurrency offers a $154 billion parallel economy for sanctioned entities, and when China's blocking orders shield $100 billion in Iranian oil trade, Washington's negotiating leverage weakens. Deals stall, energy market disruptions persist longer, oil prices remain elevated, and American consumers pay more at the pump. The energy shock tied to the Iran conflict, which has driven prices up 21.2% in a single month, is partly the product of a sanction system that can no longer fully enforce economic blockades. Rapid forced dollarization driven by sanctions, pressure can compress timelines that would normally span decades. Russia's dollar holdings fell from 41.5% to roughly 13.18% within 2 years following the 2022 sanctions. Every global reserve manager is watching this data closely. Meanwhile, the OFAC designation list expanded from 120 entities in 2001 to over 900 by 2024, demonstrating that the sanctions weapon has been applied at such scale and frequency that organized resistance was inevitable. The paradox is clear. Each time Washington leverages dollar sanctions for short-term geopolitical gains, it accelerates the creation of infrastructure designed to nullify the dollar's sanctions power. This process does not collapse the dollar. It simply shrinks the operational perimeter of its most powerful weapon, a weapon whose effective range contracts each quarter sees its strategic value decline, even while remaining the most formidable financial instrument on Earth for the foreseeable future. The data shows that while the dollar is durable, its dominance is no longer uncontested. Understanding this dual-speed evolution is essential for anyone invested in the United States' financial future. The erosion of sanctions authority is the immediate threat, while reserve currency shifts play out over decades, yet both are intertwined in ways that touch everyday American money, mortgage rates, and borrowing costs. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.